Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I'm going to look at 5 different companies in the consumer discretionary. Before I do that, if you're wondering where I have been, I've been very unwell, but alhamdulillah, I'm okay now. I'm better, the family are better, so inshallah, expect new videos in the next couple of days. But it has been absolutely crazy couple of weeks, honestly. It's mad. I've been very unwell, but alhamdulillah, I'm better now, the family are okay. That's all that matters. And inshallah I will be doing more videos. Apologies if my voice is a little bit all over the place, I'm still recovering. So in today's video, I'm going to look at the 5 companies in the consumer discretionary. We've done already 3 videos this type of videos before, focusing on the S&P 500 sectors. We've already done one for technology, one for industrials, and one for healthcare. Today we're focusing on consumer discretionary, and then we've got another 5 or 6 lined up inshallah in the next few weeks. I will be doing a portfolio update, but as you can see right now is over £60,000, which is absolutely amazing. It's gone back up again. It's been up and down in the last few weeks. As you can see, we're now on 7.5% up, or £4,200. So inshallah I'll be doing entire portfolio update in the next couple of days, just let you know how much that I've got paid in terms of income, what I've done, what I bought, what I sold. So yeah, if you love that kind of thing, please just like the video, subscribe to the channel, and as always, let me know if you have any questions. I know a lot of you have asked me questions in the last few weeks, so inshallah I will be getting to those questions as soon as I can as well. Right, so let's start the video. So today we're looking at the S&P 500 consumer discretionary side of things. Okay, this is Vanguard VZR. So I'm looking at this ETF. I'm picking the 5 best companies in this ETF. So the first company we're going to look at is, before we look at the companies, in fact, let me just explain what we're doing here if you're new here. So we're looking at the market cap, we're looking at the moat rating. So that means if this company has a competitive advantage, if the price right now, dividend yield, latest dividend increase, we look at the 5-year growth rate of that dividend, we're looking at payout ratio, so how much of the net income the company is using to pay us this dividend, how long the company has paid this, increased this dividend. We're looking at safety according to Simply Safe Dividend. We're looking at the profit margin. We're looking at the free cash flow, how much money the company has to pay off debt, to pay basically as cash, to obviously acquire other companies and so on. And we're also looking at the total return in the last 10 years, growth estimate in the next 5 years, and then Morningstar for valuations, which I absolutely love because they are quite, in terms of the evaluations, conservative. So I like them and I use them all the time. And then their fair value. But again, remember, these guys are analysts, so they might make a mistake or whatever. So when you're doing these things, do your own research as well. So the first company we're looking at today is Home Depot. This is a company that I own in my portfolio. It is $297 billion market cap. It has wide economic moat. Price right now is $291 per share. Dividend yield of 2.61. Latest dividend increase is 15%, which is above inflation, which is absolutely amazing. 5-year growth rate of 18%. Payout ratio only 45%. And they have increased their dividend for 13 years in a row. 87% safety, which is absolutely brilliant. Normally we're looking for anything above 60. Profit margin is about 11%. Free cash flow $10.8 billion, and total return in the last 10 years, if you had this company based on their total return, you would have earned about 18%, which is absolutely amazing every single year, right? Growth estimate in the next 5 years, we're expecting every single year in the next 5 years the business to grow about, the earnings to grow about 16%. And fairly valued right now $269 per share, where it should be right now. If this company comes back down again to $250, I'm definitely adding to it. The next company we're looking at is also another company in the home improvement section or sector, and that is Lowe's. $116 billion market cap, so it's slightly smaller than Home Depot. It has a wide economic moat. $190 per share, 2.23 dividend yield. Latest increase was 31%, and 5-year growth rate of 18%. Payout ratio only 27%, and they have increased that dividend 59 years. This is a dividend king. Safety, we're looking at about 93%. Profit margin about 9%. Free cash flow 7.5 billion, and total return of 20% in the last 10 years. Growth estimate the next 5 years, we are expecting about 9% and 12% discounted right now. $212 per share is where it should be. Right now it's trading $190. This is probably one of my favorite companies out there. Genuinely love the company. I will be buying more in the next few weeks. Next company is Nike. Nike is currently trading 39. I think at some point, and sorry, 93. At some point this year or the beginning of the year, it was 130ish. Right now it's only $93 per share. It's $146 billion market cap. It has a wide economic moat, 1.3 dividend yield, and then it's got 11%. You can see basically the latest increase was 11%, and the 5-year growth rate is basically 11%, which is really good. It's above inflation, which is really nice. And then we're looking at payout ratio of only 34%. So although the dividend yield is quite small, they still have room to improve that if they needed to. 20 years of basically increasing that dividend. So 5 more years and this company will become a dividend king, a dividend and aristocrat. Safety 99%. That's the highest any company can get. Profit margin 12%. $3.5 billion of free cash, which is really good. Okay, this is the money the company uses for all sorts of things, paying back their debt and so on. And total return, we're looking about 15.65% in the last 10 years. Next 5 years, we're expecting 7% growth. Right now is basically 28% discount. I'm not sure why I changed the color to red, but that color should be green because it's actually discounted. So 28% discount right now and $129 per share. I think that's where it was at the beginning of the year, but it went down quite a bit. So it is a very good opportunity to add to basically a company like this right now. So the market is giving us an opportunity possibly to add to a company that's absolutely amazing, very well known. I'm sure everyone in your family, if not you or whatever, everybody's you basically using their product. Next company is a very well-known company again, is Starbucks, currently trading 91 as well. It has a market cap of $404 billion, wide economic moat, 2.29%. I actually think I didn't think it was that high. I think it was lower than that, but because it went down quite a bit, I'm not sure what's going on. I think it was lower than that. I think it was one point something not long ago, but latest increase was 8%, and the 5-year growth rate basically was 14%, which is quite nice. Payout ratio 66%, slightly high. Okay, slightly high, I'll be honest with you. Dividend streak, basically they're 12 years of increasing that dividend. Safety is 67%. That's probably why. Maybe because it's this too high, that's why this is quite low. Okay, profit margin 13%. It's still safe though. 61 and above is normally safe, but profit margin 13%. Free cash flow $3 billion. Total return in the last 10 years, we're looking at about 15%. 16% growth expectation based in terms of the earnings are expected to grow about 16% every single year, and 13% discounted right now. $104 per share is where it should be. Right now is just above that, 91. Okay. Right, so then final company is TJX companies. This includes the TJ Maxx and all of that. Okay, in the UK that we have TK Maxx. Now $83 billion market cap. It has a narrow economic moat, $71 per share. Dividend yield of 1.65, 13% dividend increase recently. That's quite high. That's actually quite nice. 15% increase in the last 5 years is also great. Payout normally I look for 6%, 7%, but 15%, that's absolutely amazing. And every single one of these companies actually increased more than what I normally look for. Payout ratio only 37, but they've only basically increased that dividend for first year. So we'll see how that goes in the next basically 5 to 10 years. Safety is 80%, which means it's very safe, and they have a profit margin of about 7%. And in terms of free cash flow, they have $823 million, so it's less than $1 billion basic company. They are quite they're not actually a small company, so they should have a slightly bit more cash in hand, but yeah, that's I think it covers the dividends, but it will be interesting if they can sustain this increase then in the next couple of years. Total return in the last 10 years, we're looking at about 14%. And then in terms of basically in terms of growth, the next 5 years, they're expecting 11% growth every single year. Right now, for that reason, probably it's a premium $64 per share, and right now it's looking about 71. So it needs to come down quite a bit in order to be attractive. I'll be honest with you, because of the free cash flow, I probably would not be looking at this company until they start building a little bit more cash, although this covers the dividends, okay? But sometimes I do like companies that have a quite substantial free cash flow, especially going to probably end up recession very soon, or we might be in recession already in, well, we are in the UK, but in the US they're still in denial, okay? But if that's the case, we need to make sure these companies do have enough cash to kind of go through that recession period of time, okay? Right, there you have it, 5 different companies that I thought that would be interested to you. So what I'm going to do now, quickly show you the portfolio of all the other companies that are in there. So when we look at this consumer sector, consumer and discretionary sector, basically these are companies whose products are not essential. So it's like they're not like food and whatever. You're basically talking about decorations, footwear, homeware, things that we probably will not spend money on, hotels and resorts and so on, okay? Changing your home appliances, that kind of thing. Because some, people, when you're worried more about feeding your family, you're not going to go to Home Depot or buy new furniture or whatever, you know what I mean? So you're not going to do that. So let me quickly show you the companies that are in there. Companies like Amazon, Tesla, Home Depot. I didn't include Tesla because obviously they don't pay any dividends, but at the same time, it's a very speculative company. It's still growing company, so I wanted a mature companies. But Amazon has done quite a lot. It's questionable in terms of Sharia compliance side of it, so that's why I haven't included in there. McDonald's is definitely one of those companies I'm not touching. Lowe's, Nike, basically Starbucks, TJ Maxx we've already done. Target is one of those companies as well that's questionable, because the company, there's a loads of shops in there that sell all sorts of things. For that reason, Target is questionable. Booking.com is one of those companies that is in there. Again, this is a growth company, so don't pay any dividends. But yeah, there's a lot of great companies. If you're interested, just type VCR, Vanguard Consumer Discretionary ETF, and you'll find everything you need to know. But the 5 companies that I want to share with you, these 5 companies. Hopefully in the next couple of days, as I feel better, I will be planning to do a lot more videos just to kind of update you in terms of what's been happening to portfolio and generally where we are with everything else in the stock market news and stuff like that. So if you're enjoying these kind of videos, please like the videos, subscribe to the channel. Let me know if you have any questions. Assalamu Alaikum. Take care.